What happens when you're looking at superannuation where, look, I would hazard I'm probably a little bit older than most of you, and I've still got to wait over 35 years before I get access to my super. That's really far down the track to be able to pick that stuff up. So how do you think the companies would account for that? Do you think they could just say, well, we don't have any sort of recognition of anything now, and this just in 35, 40, 45 years time, we just suddenly have this big expense crop up? It's not an easy thing to deal with, and that's why we have a standard like what we do. So a really important point with all of this is, and I'm actually going to just step out a sec from talking about sort of the technical parts of accounting, and this is more kind of, whether it be career advice or just something to think about, is a lot of what we're doing and a lot of sort of the practical type stuff, yeah, it's important to know the nuts and bolts and just mechanically how things work, because if you can know mechanically how things work, you got a better sense when things start to move around what the impact of that is. But realistically, most of the mechanics and the calculation type stuff, that's where you have computer systems and spreadsheets will automatically be able to do that. What becomes important is understanding, I suppose, the professional judgments, the professional assumptions that are getting made and the impact that those have. That's where accounting is going, and that's where, I suppose, knowing how to do this stuff becomes important. It's knowing how to make those professional judgments. And that's not just, let's get a spreadsheet, just plug some formula in and have that pop out. It's actually trying to figure out what decisions are getting made to give us some sort of output. So even though it's a bit of a throwaway there, it is actually an important thing. Anyway, back to what we're talking about. It is an economically significant issue. So we're talking about service economy, knowledge economy, IT firms are sort of burgeoning. You've got Google going crazy. You've got, web companies and .com companies and all this sort of stuff making money. People are involved in these things. You could argue Australian manufacturing suffering a little bit. Staff expenses, even for manufacturing, even non-service firms, staff expenses are a large proportion. In Qantas's staff expenses are about $3.7 billion. So it's about a quarter of their total expense is their people. And this is for a company with massive amounts of property, plant and equipment. The proportion of staff costs here, I had a look at our annual report today, is 61%. So 61% of the university's costs are staff related, which makes a lot of sense because what we basically do, we're in a service industry. So that does make sense to have such large costs. But it is a big issue. Now, this happened 3 years ago, but these guys early adopted over in the US. This is what I want to talk about a little bit later today. Honeywell, which is computer manufacturer, they're in computing as far as I'm aware. They adjusted their accounting to bring onto the balance sheet and profit and loss nearly $5.5 billion worth of deferred losses in relation to their superannuation or into their pension plans. That is not a small number by anyone's imagination. Now, this is the change that is happening right at the moment. And I just want to show you if I can get this up. And I put this article both on our Facebook and Twitter. And document reader, go. Oh, sorry, it's not touchscreen. There we go. Okay. So this was an article that came out yesterday in the Herald. Okay. Defined benefit shortfall to crimp profits. Some of Australia's biggest companies face multi-million-dollar increases in the cost of their defined benefit staff super funds as new accounting rules take place. And I'll just flip down so you can read the full amount if you want at your leisure. The Commonwealth Bank recently said the change would increase its cost by $80 million this year. Now, the Commonwealth Bank is a big company, so as a proportion, it may not be that material. Still $80 million is $80 million. But there's significant changes that are going on there. And A little bit later on, we're going to go into a little bit more detail on Qantas because the amount that they're dealing with is bigger than that. And they're a they're a smaller business than CBA. So we'll have a look at them in a sec. I'm so used to using an iPad at the moment, you just want to... Okay, so employee benefits. So AASB 119 deals with employee benefits. There have been some changes lately, as I'm alluding to, and as this article alluded to. The technical parts of that you don't have to worry about for this subject in terms of assessable items, but it's just something to be aware of, that that's what's happening. So, key considerations. There are 4 things that we want to worry about, and funnily enough, there are 4 types of employee benefits. So the first thing we're looking at is types of benefits, then when, how much, or how to recognise and how much to recognise. Everything gets included in the scope of this particular standard. So anything that an employee gets comes in here, apart from share-based payments. Hi guys. Still paying attention? All good. Employee benefits. Now there are 4 types, and if you think about it, it's kind of working in the short term, and wages and salaries comes in that bit. So the big chunk of what we get is actually short-term benefits, and the accounting for them is very straightforward. We have longer-term benefits, so things which you'll get over the longer term. You'll have things which you get basically if you get fired, and then you have things which you get after the fact. Now, so short-term wages and salary, sick leave, annual leave, profit sharing bonuses. I certainly don't get profit sharing. A university does not make a profit, we make a surplus. And that's an important distinction. We're not a profit-making organisation. Non-monetary, certainly don't get those. Post-employment benefits, we're going to be focusing on the pension side of things. Other long-term, the long service leave section is the bit that we're going to focus a practical on. And it actually has some takeaway for the calculation for pension accounting, but we're not going to go into the absolute detail for pension accounting. And termination benefits, we'll mention briefly, but we're not going to pay a huge amount of interest to that. So, short-term benefits. Now, as you're reading this, think back to the framework definition. When an employee has rendered service to an entity during a reporting period, the entity shall recognise the undiscounted amount of the short-term employee benefits expected to be paid in exchange for that service. So, the employee has rendered service. An event has happened. So you're not trying to look forward to what they're going to do in the future. You're looking at what they've done to date. And it's undiscounted, and it's what you expect to be paid. So that's the economic outflow. Now, how you account for it is as a liability if you haven't already paid everything that's owed to them. And what we're talking about there is sort of accounting A, where if you get to the end of the financial year and the pay period ends a couple of days or a week or so after that, and there's a few days where they haven't been paid, that's accrued wages. So debit wages expense, credit payable, debit wages payable, credit cash. There's nothing that convoluted with it. That's straightforward. So we'll move on. Absences. Now, absences are a little bit more involved, but not hugely. So there are 2 types of absences. There are accumulating compensated absences, and there are non-accumulating compensated absences. Now, I know from what my sick leave and my annual leave that both of those are accumulating. And what accumulating basically means is if I don't use my 4 weeks of annual leave this year, it rolls forward to next year. If I don't use my 4 weeks next year, it rolls forward, so then I'll have 8 weeks and so on and so on and so on. I mean, technically you're not allowed to accumulate more than 8 weeks. I mean, people do, but you start getting nasty emails saying, look, you should take leave, head off and have a holiday because you've been working too hard. I think they can kind of force the issue a little bit, and they can just take leave off you if you don't take it after you've been warned, but I don't think that's ever really happened. Actually, there was a case a couple of years back of the Macquarie Uni VC who had managed to accrue one whole year of annual leave. So if you're picking up 4 weeks of annual leave a year, and there's 52 weeks in a year, she's managed to accrue, 13 years worth of annual leave, which is basically saying she never took a holiday for 13 years. And when a VC pay packets aren't small, I mean, you're talking $500,000, $600,000, and she would have got paid for that. So you walk away at the end and you get paid $500,000 or $600,000. Did I think that she never took a holiday in 13 years? I mean, I don't know. I mean, they work hard, but I don't think they work that hard. Anyway, that's beside the point. So accumulating as it rolls forward. Non-accumulating depends on what type of mobile phone plan you are. Unused credits don't get rolled forward. That's exactly what that is. So if you get to the end of the year and you haven't used up all your days of sick leave, for example, you don't get to roll them forward to the following year. Now, in some ways, it wouldn't make sense for a company to have sick leave as non-accumulating, because imagine you got 10 days of sick leave a year, and if you didn't take sick leave, you lost it. What do you think a lot of people are going to start to do? They're going to chuck sickies. So they're going to take sick leave because they know if they don't take it, they're going to lose it. So it sort of makes sense for sick leave to be accumulating because it stops that problem. But non-accumulating sick leave, non-accumulating compensated absences, you only recognize the cost of that when the absence actually happens. If it's accumulating, you recognize the cost of it as the employee renders their service. So for me, if I'm accumulating 4 weeks of annual leave a year, they're gonna roll up a liability of 4 weeks worth of pay every year. Let's just say I don't take any of my annual leave. They're gonna have a liability of 4 weeks sitting there at the end of the year to recognize the fact that that's accumulated. That's